In this episode, we speak with David Katz, Managing Director at Charlesbank Capital Partners, a $24 billion middle market private equity firm that spun out of the Harvard Management Company in 1998. Drawing on its endowment heritage, Charlesbank takes a research-based approach to investing across its four target sectors: business and consumer services, healthcare, industrial, and technology. The firm partners with management teams to help businesses unlock value and accelerate growth. At Charlesbank, David oversees the firm's business and consumer services sector team. Since formalizing the sector in 2019, Charlesbank has been among the most active and successful private equity investors in business services, including several notable realizations. Charlesbank views the services ecosystem as offering compelling and durable opportunities for continued private equity investment. David has been with Charlesbank for nearly 13 years, during which time he has also helped to advance the firm's investing system, including its fan of outcomes underwriting approach. He is a member of the firm's investment committee and previously worked at Bain Capital and McKinsey. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of Growth Cap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
David, thank you so much for taking the time to chat with us today. It's a delight to be with you.
Glad to be here, RJ.
So I think a good place to start is the history of Charlesbank, because many may not know that it has its origins at Harvard.
Definitely. So Charlesbank spun out of the Harvard Endowment back in 1998. So we have deep roots in long-term research-based investing. We were actually the private equity arm of the endowment back in a period when the endowment had a bunch of these in-house investment teams. Many of those became independent into the late 90s and early 2000s. Today, we're an independent firm. We manage about $24 billion across private equity and credit strategies. And our most recent flagship fund is a $4 billion fund.
And you joined the firm back in 2013. Your focus is on business and consumer services. Has that always been your focus area?
Yeah. So I joined 13 years ago. I'm a partner who leads our business and consumer services sector. That's been a focus of mine. In particular, I spend most of my personal time on the business and asset-light financial services side. We really have three subsectors within our group. It's business and professional services, asset-light financial services, and then the consumer-related services. In total, we're one of four of the sector teams at Charlesbank. And, if I could just pull back for a second, I would say what drew me to Charlesbank originally was the culture of humility and intellectual rigor. We're very much, given our endowment heritage, focused on superior research-based investing. We're very thematic, and that fit very well with my inclinations as an investor. We really do strive to learn from data and continually aspire to get better at what we do. Until kind of the late 2010s, Charlesbank was a generalist firm, but even within that, we were always very focused in terms of our thematic orientation. We were just not structured top to bottom by sector, but we made that decision to do that back in 2019, and it only further enabled us to be better at the research we do.
And I'm curious, as we focus on research and maybe like before you even embark on looking for deals and starting to talk to founders and CEOs, how do you kind of formulate those target areas? It seems like you would have to almost in real time be getting feedback from the market.
Yeah. So we like to say that we invest from confusion to clarity, which really means at a high level, taking underappreciated businesses or complex situations and turning them into clear value creation or growth stories. So there are really three common prototypes of deals that we look for. One is complexity. So think carve-outs, founder-owned businesses, complete teams. The second is hidden value. Under monetized growth levers, we can help accelerate, or a business transformation opportunity. And the third is contrarian. So that could be a macro moment like investing in the GFC or a good business in an out of favor subsector. And so Obviously, that's a very specific range of business types. But within that context, we're then looking for opportunities that really fit two key attributes. So the first is downside protection, often means recurring or repeating revenue, non-optional services. It can be structural protection. And given our endowment heritage, we're just very focused on not losing our money. But more importantly, or just as importantly, is spring-loaded growth. So basically, we want the ability to double or triple EBITDA over our hold period with high conviction. So as a result, when we're looking at opportunities, there are certainly some thematic areas where there could be a very fruitful universe of companies to look at first glance. But when we really get into it, there's a very specific prototype of a deal that we think is interesting for our type of capital that may only come down to a very short list of companies. So in those cases, we'll be very deliberate about tracking those businesses and getting to know those teams long before any opportunity is actionable. And if they're all not actionable at a moment in time, we'll put that on the shelf and revisit it when those opportunities are actionable.
And as you're evaluating investment opportunities, are you always looking to see how you could impart your operational capabilities onto that company? And so it's fairly consistent in how you interact and create value with each portco?
Yeah. So if you'll indulge me, an example here will probably really help illuminate our approach. So Lido Advisors is a high net worth RIA wealth management firm based out of Los Angeles. We invested in that business back in mid 2021. In that case, when we invested, it was partner owned, had no C-suite, never had institutional capital. So very much a situation of what we would call complexity. The business, though, had very impressive organic growth, so 20% per year, enabled by a couple very attractive referral relationships that were not yet institutionalized. They also had no meaningful M&A track record in the context of a very fragmented market. So there was a lot of untapped potential there. We are part of quarter underwriting. So we learned a few years ago that the first 2 years are really incredibly predictive of the ultimate investment result. So we focus a lot of our underwriting on trying to understand what is the range of reasonable drivers in an investment in the first 2 years to then come up with a view. We use an in-house statistical tool we call the Phantom Outcomes, really understand what does that histogram of potential outcomes look like in the first 2 years. That's an underwriting. For value creation, then, we really start from those drivers and we focus in on those items that will really move the needle, especially in the first 24 months. And what are the key enablers? For example, talent being the most notable one. And then we leverage our dedicated portfolio resources group, which has functional experts in talent, marketing, technology, operations, plus the broader Charlesbank network of over 800 executives to try to move the needle on those drivers. So at Lido, for example, we focus on three things. One was building that full senior team, CFO, COO, roles like that they had never had, creating an M&A engine that executed over 10 acquisitions over our hold, and then institutionalizing those existing referral partnerships and adding new ones to continue to drive best-in-class organic growth at scale. And in that case, we were able to grow that business from roughly 20 million of EBITDA to about 100. And we sold a majority stake this year. I still hold a very significant minority stake, and we're very excited about the next leg of the journey. But I would say that type of prototype, while the specifics will vary, is fairly generalizable to every deal. We always start with a strong start plan, really focused on the key value creation drivers, and then leverage our PRG team to really help move the needle on what those are and how to get them to the highest potential outcome of scale.
So with there being this strong intention for the first 24 months to really influence and impact the company, do you always do a similar thing where you drop in a C-suite or those key executives, which then enables you to really move forward in an accelerated fashion through the rest of your changes?
So on that front, it will vary. So we're very much a partnership-oriented firm. So we will work very closely with the management team and in many cases, the founding team that's in place. So at Lido, for example, we backed the CEO and the president, and the founder was stepping back to retiring to be more of a chairman. In that case, they're unbelievable executives. They did an incredible job. both before and after our investment. And so it wasn't so much about the whole C-level team, but it's very common that we'll come into a situation like that and have a business that is a little subscale and has not yet had a CFO, has not had a COO. They may never have had a formal growth officer. And in those cases, we will work very hard through our talent team to enable the management team to find, kind of fill those roles. And our general mentality is to invest very heavily in building that type of infrastructure in the business so that it is capable of scaling and it can reach its full potential. We obviously are EBITDA investors at the end of the day, but we're very much ROI-based investors. So when there's a return to making tangible investments from your cash flow, we believe Salesforce, M&A are great examples of that. We're always a believer in doing that early and doing that in an aggressive manner.
The category of business services is fairly broad, and you mentioned financial services examples, but I'm curious as to what the other kind of maybe sub-segments are within business services that you look at.
Yeah, so we really have within our group, and the history of our group is we used to have a business services team, which is where I've always spent my time. And then we had a separate consumer team, and they came together about 2 years ago. So now we have really 3 separate pods. One is the classic business services. So that would mean, in most cases, the way we define it would be white collar professional services. So something like the office of the CFO, ecosystem, or governance, risk, and compliance, businesses like that. We also will cover tech-enabled services within that range. Then in the financial services pod, and again, at the top level, we are cross-cutting, but our team members, as you get more junior, actually get much more specialized, just given our research-focused approach. So the second pod is asset-light financial services, I would call it. So we focus there on businesses like wealth management, or like the Lido example we just talked through, or insurance brokerage. And then the third pod would be consumer services, which I would think of businesses like residential services. We've been very successful in HVAC, for example. Another would be B2B consumer related services like an Amazon accelerator business that we've partnered with.
Mm-hmm. It seems that folks stay at Charlesbank for quite some time. Tell us a little bit about the culture at the firm.
Yeah, we have a remarkable amount of consistency in our team. I think it comes down to your first question, actually, the endowment heritage. We have a very collegial and partnership-oriented culture and a real focus of the humility and importance of stewardship. So we take our jobs very seriously. We try to be pleasant people to be around. And we carry that through in our hiring and in our day-to-day processes, which I think has enabled a lot of our success. I think even just as importantly, if not even more so, is the culture of continuous improvement. So we do after action reviews after every deal pursuit. We do 2 offsites a year where we go through our research and talk through themes, but we also spend a lot of that time trying to think about how we can do better and what we can learn. And as a result, that learning mindset has been an edge for us as we've evolved and just continue to get better.
Are there areas of investing? I mean, investing involves a lot of different kind of skill sets that you would say you were significantly better at today than you were when you first started?
Yeah. If you step back, I would say Charlesbank today is a system. So it comes down to 3 core pillars. One is the thematic sourcing that we talked about, really having deep research-based conviction. The second is rigorous underwriting, which is based on that, in part on the 2-year statistical framework, fan of outcomes that I mentioned, as well as really data-driven analysis. And the third is strong start execution, which is disciplined, driver-focused value creation plans. Now, we've been around 27 years, so we've seen a lot of different market cycles. The private equity industry has changed a ton. We've gone through .com, GFC, COVID, rising rates now. It wouldn't be genuine for me to say that our system and approach has been identical throughout all that. Like, it's clearly changed very significantly. And I think it's back to the learning mindset. We've really evolved. And I would say the most notable example of that is the learnings that led us to those 3 prongs that I talked through. So at one of those offsites that we chatted about earlier, we actually regressed as part of that, our investment results against a bunch of different metrics. We were trying to understand what variables are really predictive of outcomes. So we looked at entry multiple, which was obviously a big focus of what I call private equity 1.0, where it was just trying to buy the cheapest companies possible. We looked at organic growth and said maybe it's just the fastest growing companies. We looked at M&A volume. We looked at management, which is actually very hard to predict early on because sometimes inherently that's a noisy judgment. But we tried looking at everything. Our original hypothesis were really around multiple and growth. And what we saw with entry multiple is there's a very low correlation with ultimate results where, paying less didn't mean a better outcome. And similarly for growth, we felt organic versus M&A were not that predictive. Overall growth obviously is very predictive with a result as you would expect, but it's harder to ex ante value necessarily. So when we came through that, we found that one of the best predictors of ultimate outcome was the first 2 years of performance. And that critical insight led us to rejigger our whole system around trying to ensure that we were finding businesses that could generate that type of return in the first 2 years, and then really using our own operational toolkit to try to get them to that level. Mm-hmm. And what we find is if you grow EBITDA quickly out of the gate, it's very hard to fail ultimately. And if you don't, it becomes difficult to rescue after some period of time.
Would like to touch on your personal background. Where are you from?
So I grew up in New Jersey, right outside New York City.
Awesome. I'm in Princeton.
Oh, very nice.
You decided to go to Harvard undergrad. What was your focus in undergrad?
Yeah, so I majored in economics as an undergrad, and I spent a lot of time actually at one point thinking about whether I would become a professor, but it was too intangible for me. So I pivoted towards business and joined McKinsey out of college, which was really the best of all worlds from a learning perspective, but ultimately felt that could generate much more value with the seat at the table. And sort of the investor lens has been a real opportunity to bring together the best of thinking through businesses while also having the operational opportunities to work together to make companies better.
What might be different? And some, we have a fair amount of like younger folk or younger private equity professionals that listen in on this podcast. And for them, we try to differentiate what makes Charlesbank different. It's research focused, thematic, but maybe like the feel of the institution of Charlesbank. How is it different than other private equity firms?
Well, I think you hit on a couple items, and inherently those are a little intangible. So just to bring it to life, I think the biggest thing that differentiates us is our culture, which comes down to the ability and willingness to think about what we could be doing better, to the earlier conversation, and to try to take action to get better. And I think it's also just a very fact-based collegial atmosphere where we're not afraid of sharing things that went wrong and our own opinions in a friendly way. Mm-hmm. We're all trying to get to the truth and to the right answer. It's not about judgment. It's not about politics. It's not about who did this versus who did that. It really is a process and a system around getting to the best investment outcomes. And everyone's working together as one high-performing team to get to that result. And it's hard to really build that from scratch. I think there are obviously other firms that have great cultures, but what we've been able to do is foster that from the beginning, and a credit really to our founders and our current managing partners who've enabled that. But it's a real edge for us, I would say, in terms of recruiting talent. The other thing I note is that we're big believers that ideas can come from anywhere in an organization. Quite often, great thematic ideas or opportunities will come from a VP or relatively, or even an associate, relatively young person on the team who had a great idea. And then we always welcome that. It's not about hierarchy. And we have our ICs that are open to the entire firm. The whole investment team will be there as opposed to just one individual or just a very small group, which has enabled a lot of learning and collaboration over the years as well.
Okay, last two questions. One is, can you tell us about a person who's had a profound influence on you?
It's tough to pick just one, so I'll give you two, if that's okay. One personal, one professional. Personal, I would have to name my grandfather. I was named after him, so I think about him often. We're only 2 generations apart. He but very different lives. He was born in Eastern Europe. When conditions were worsening during that interwar period, he fled on his own as a teenager to build a new life. So his legacy and his values really around grit, humility, calm through adversity are things I think about frequently and important learnings for how I approach challenges as an investor, even as I realized there's obviously a comparison to what he went through. On the professional front, I'd name our CEO, Mike Che. He likes to say that decision quality compounds like capital, which I keep in the back of my mind when making decisions. And as it relates to business services in particular, Mike's support, involvement, thought partnership have been instrumental as we've doubled down our efforts there over the last 5 years. And he's a rare leader who combines that analytical rigor with genuine empathy and mentorship, which has had a big impact on me and something I strive to emulate.
Last question. Can you tell us about a charity cause or other endeavor that you're passionate about?
Definitely. So start with a quick anecdote. Before college, spent a summer in Peru building infrastructure. That was a very formative experience for me. First time I'd been to the developing world, seeing the way many people live there. And interestingly, I thought at the time that I needed to go abroad to really make an impact on these major societal crises. But when I returned, I started seeing that there's actually a lack of infrastructure for so many here in America too, particularly around housing and homelessness. I just hadn't been exposed to it growing up in New Jersey, like we talked about. It's too easy to work hard and not think about it. So since then, I've become a strong supporter of Community Solutions, which is a nonprofit that uses data and systems thinking with the goal of tackling homelessness. The goal is really to make homelessness functionally zero, which means effectively rare and brief, because there's always going to be some of that, unfortunately. And they do it by unifying disparate community groups that are trying to help, but need central accountability, using real-time data, and making targeted investments in housing. In many ways, it's very similar principles to what we value as investors: rigor, persistence, accountability, to obviously one of the hardest social challenges out there to solve.
Wonderful. Well, David, I want to thank you again for taking the time. It's been a great conversation.
Likewise. Thanks a lot.